Hey, so everybody wants to know what's going on with interest rates. We saw them come up late this summer and heading into the fall, and a lot of buyers have fled the real estate market. They were seeing high numbers. The prices of the houses just rose. Many people just bailed out because it was just too high. They needed the prices to come down, but the rates were low. And last year we saw as low as 2%, 2.5% for your average person to get a 30-year mortgage. That is no longer the case. Those rates are gone. We're going to see what Mr. Paul has to say, Paul Donovan with HFC Lending today. And he's a friend of mine. We've known each other a long time. I just wanted to get him on and get some perspective on what we think is going to happen with rates and what the possibilities are. Because I'll be honest with my audience right now, here's what real estate agents are saying. They're saying, marry the house and date the rate. And I think I don't know that I like that phrase, because I think it's a little bit like, it's a little trite. And I think it's hard for buyers right now to say, yeah, the rates are, I'm just going to hold on to this rate for a little while, buy the house that I can today, the house that I can afford today. And I can see on the horizon that the rates are going to come down. So Paul says they're going to come down. Paul, I brought you on specifically to, just talk about this today and get some information out for people. So thanks for joining me.
Thanks for having me, Chris.
Yeah, absolutely. So I know you sent some charts over. Let me know what you'd like to talk about.
Well, the reason that rates went up is that inflation went haywire, and my 30-year fixed hates inflation. Let me just start by saying I love Fed rate hikes. I love them. The common misunderstanding is that Fed rate hikes mean your 30-year fixed went up. It doesn't. Home equity line went up. Credit cards go up immediately. It's the overnight lending rate. But what my 30-year fixed hates is inflation. And inflation is the enemy of bonds and mortgage-backed securities, which drive mortgage rates. And it's kind of the old adage, the enemy of my enemy is my friend. So the Fed's enemy is inflation. My 30-year fixed, their enemy is inflation. And so if the Fed is attacking inflation with rate hikes, I love it.
Yeah.
We haven't seen it come down yet. In fact, we had a lot of damage today. My 30-year fix, I'm a broker, so my 30-year fix is going to be on average about a half a point lower than retail banks. But it's still, 6.375 with a point, 6 3/4, no points. I mean, that's crazy. That's well over twice what it was at the beginning of the year.
And for some of our new buyers, what Paul is talking about is a 30-year mortgage. You buy a house on a 30-year mortgage and you get a fixed interest rate. So I'm going to break it down just a little bit. There are many different loans. Some have a fixed interest rate where your payment stays the same, basically for a very long time, unless some of our tax laws change. But let's just, for purposes of this, a 30-year fixed loan is the standard loan that people get. The loan lasts 30 years, the rate is fixed, your payment doesn't change. Most people like that. And there's a lot of really good reasons to get into that loan, because your rent may change, probably will change. Your circumstances may change, but your payment on your house won't change. And that gives people a lot of security. So that's what Paul's talking about with 30-year fixed.
And then we, of course, have the adjustable rate mortgage. You're referred to as an ARM. And it depends on the day. Sometimes there's a benefit to an ARM. Again, if you want to keep your loan forever, you want a 30-year fixed. But right now, none of us want these rates. I'm going to make a case for it. I think they're going to drop. And so you don't need the security of a 30-year fixed right now. You just need a placeholder. And so in that case, if the day calls for it, an adjustable rate mortgage may be appropriate. But again, we just offer that advice on a daily basis as the market dictates.
Yeah. So let's put a little proof to your theory here. Can you see the screenshot? Yep. Okay, great. So here we go. Let's just play this real quick. How does that look?
That's great.
Great. So what do we got here?
This first slide is a chart of what inflation has done since June of last year. You'll see that in the dip there between July 2021 and September 2021, it was quite low, right? As of August, we were at 0.6%. We were slightly less in September. But what they do is they do a year over year average. And so when you're averaging with that low September number last year, your average is skewed higher because they're incorporating a low number there. And so what happens is that as we move into mid-November, we're going to be averaging with October of 2021. So look at that chart. What happened in October? Inflation shot up. So now we're on a level playing field. We're now averaging with months that are equivalent to about where we are. So even if inflation comes out exactly the same for October, which we get November 13th, the headline will be that inflation has dropped because we're now averaging with a higher October last year. So that's my prediction, is that in a few weeks, we're going to see a headline that says year over year inflation has dropped. Oh, it's just because we're looking at this chart here, we can tell that's going to happen. Unless for some reason it spikes, but it's already on the decline. I firmly believe we've reached peak inflation, and that from here out, we're going to see rates steadily creep down, hopefully as soon as 3 weeks from now. But it'll be a slow process.
Okay, so Paul is predicting that rates, and you're talking about mortgage rates.
30-year fixed mortgage rates.
Mortgage rates are going to come down. Okay, so we'll see how he does on that. I have a question for you.
Yes.
Sometimes I hear that the market has already taken into consideration the Fed hike. Okay, but every couple of weeks, well, I don't know how long it is, every month or so, we're waiting for the Fed. Oh, they're going to make an announcement, right? Why is it sometimes the market has taken into consideration the Fed hike, and sometimes it seems like they're reacting to it?
Well, because they telegraph ahead of time. For example, at the beginning of November, they've telegraphed that they're going to be doing a 75 basis point hike. And then again in mid-December, another 75 basis points. But in between then, if reports come out that are high inflationary, that can signal to the markets, well, maybe they're going to go 100 basis points. So that's where then we're reacting to news that comes after the Fed has communicated what their plans are. Okay. Right now, they're planning on 2 75 basis point hikes before the end of the year, and then they're going to cool it for a while, which is wise.
Okay.
Because it takes a long time for these Fed hikes to take effect. They've probably already done enough, but
yeah,
they're hitting this aggressively, which I appreciate.
And for those who don't know out there, what we're talking about is the Federal Reserve Bank setting the rate for what other banks can borrow, the rate that they can borrow money from, basically from the government, from the Fed. And it has a ripple effect. And their purpose right now is to tamp down inflation, to push inflation down, because they say prices are too high on everything. But everything they do has a long-term kind of effect, right? Would you say that's fair? Yeah. Yes. So people who try to time the market, time the real estate market, is different than the stock market. You're not going to see an immediate response. You will see the stock market respond, and it's been responding dreadfully, but you won't see real estate prices respond that quickly. Right now, prices are going down, but they were already inflated. So if you blew up a balloon twice as big as it should be and you reduced it down in size, it's actually coming back to normal size. It's not a great example, but there you go. Okay. Did you want to talk about
before we move on? Let's pop back. So you and I were talking about home values rising, and then right now they've come down. And so why did that happen? We're in a period of hibernation, as you alluded to earlier. People were, Chris, we were doing deals. People were willing to step up. No appraisal contingencies. Bid over ask, they still wouldn't get in, and just time after time, it was crazy. but the rates were reasonable and people were still willing to do that. But then rates jumped, and that's when so many, and we had clients do this. They just said, all right, enough.
Yeah.
I'm gonna go sign a 6-month lease. I'm going back to my apartment, back to the rental, and this is not working for me. And so that's where we find ourselves now. We still have low inventory. It's not like in the last number of months, the inventory problem has been fixed, and we'll go into that in a little bit. But that's why we're kind of at a stasis right now. But I'm going to make a case for that picking up soon.
Yeah.
Okay, so let's go on. Let's go on to the next slide.
Yeah, and I want to talk through what's happening with homes and home prices before we finish. So we're doing good on time though.
And if you scroll down a little, one more notch, there we go. It'll pop up. Okay, so when I'm watching the news and I hear talking heads say, "Oh, we're not heading into a recession." Unemployment is low and job growth is robust. I yell at the TV and my wife says, "They can't hear you. They can't." But it drives you crazy because
take it easy, Paul.
if you look at this, no yelling today. But if you look at this chart all the way back through 1950, the dark lines are recessions. The white line is an unemployment chart of the unemployment rate. In every recession, where's the unemployment rate? It's in a valley. It's its lowest point right before the recession and then during the beginning of it. This is a recessionary indicator. So when they say, I get so frustrated when they say, "Well, unemployment's low," I'm like, that's a telltale sign. So anyway, so low unemployment right now, one would think, oh, we're in great shape. No, we're already in a recession. We have had 2 quarters of negative GDP growth. Every time since 1947, that has been called a recession. Right now, they're redefining the definition. They've got like depth and duration that they've added. No idea what that means, neither do they. But they're just, I think it's a political move. I think it's about, kind of staving off reports of a recession until the midterms. I really think that's what's behind it.
Okay.
We're in a recession. And so let's go on to the next slide.
Can I ask something before we move on?
Yeah.
Some of these lengths of time have been different. Some of these look really long, like the early 80s, and that was devastating.
Sure.
And 2008 was devastating. This does the war and kind of what's going on right now play into the length of time that we're going to see, in your opinion, on this recession?
Good point. In fact, that was another point I was going to make on the previous slide, and that is that the pandemic shut the world down. I mean, it was unprecedented, right?
Yeah.
And so when they allowed us to go out with masks, demand was immediate, but the gears of industry had to start churning slowly. So the supply wasn't there, supply chain issues, and that's where we got inflation. Now, Fed sat on their hands. If you recall, they used the term transitory because they said, oh, this will work itself out. This is just the result of the pandemic. And they were probably right. And then in March, Russia invaded Ukraine. And that is when inflation shot up because Europe was so impacted, fuel and food shortages, and that of course washes up on our shores. So that impact we've already kind of absorbed. And that's when the Fed all of a sudden said, oh my goodness, this now is not going to take care of itself. We need to aggressively fight this. So that's when the Fed, you'll notice when they really started fighting inflation. So
that makes sense, yeah.
And so this recession, who knows? But the reports are that this one will be a mild recession. It's not going to be like 2008. It's going to be a mild recession. We've already absorbed the impact of the repercussions of the war. That said, to the degree that Russia, they cut off oil supply to Europe, to the degree that lingers is going to make their inflation soar, and that will have a residual effect on us. But for the most part, I think that we've already absorbed that major hit. It could stretch things out a little bit, but nothing like 08.
Okay. So you don't think it'll last that long is kind of what you're saying.
No, even Jamie Dimon from Chase is saying probably 6 to 9 months.
Okay, but that could be most of next
Most of
year.
2023. Yep.
Okay. All right. That's good. All right. What else?
Let's go on here. So what happens to mortgage rates during recession? So if we've now, if you're riding along with me here and you say, okay, we're likely in a recession, we are in a recession. So if we are in a recession, what happens to mortgage rates? Well, going back to 1980, you can see during every recession, mortgage rates, and if you click one more scroll down, you'll get a little bit more here, a few clicks actually. We'll see that rates drop between 1 and 4% during recessions. And so we should expect that again here as we finally feel the effects of the recession. We should see rates come down. This is why I'm saying, and when will this happen? I'm thinking it's going to start happening mid-November, and that by the spring we're going to see rates well under 5%, and I'm hoping and I think well under 4%. I think we're going to see a 30-year fix at 3.75 again.
Wow.
In 2023.
You heard it here, folks. First. Anyway, well, I hope you're right. I really do hope you're right. Because I think it makes it so much better for people to get into houses right now.
Right.
So yeah, the charts are compelling. That's really amazing data there for sure. Cool. Is there another? Okay, so those are all the
Here we go.
What do we got?
Well, okay, so if we've established that we're in a recession and we can see that rates come down in a recession, my perception, and I would think most home buyers' perceptions would be that if we're in a recessed economy, that home values would come down. But we want to look at supply and demand. So when we look at household formations, we've got peaks and valleys over the last year. If we kind of draw a line down the middle, and I want to make a case for the fact that housing continues to rise. So if you draw a line down the middle of this chart, you're going to come up with new household formations at about 1.7 million a month. And new household formations are, of course, kids moving out of their parents' homes, divorces creating two households where there was one. So these are brand new formations, not selling your old house and buying a new one. 1.7 million. So let's go on to the next slide.
And you're talking about a number, not a value. So you're talking about
1.7 million more houses in the country. These are national numbers. Now, real estate is local, so these will be skewed market to market, but we're trying to establish kind of a baseline.
Okay.
Oh, and this slide, unfortunately, another slide laid over it, but we can still get the information we want from it.
Okay.
So these are new starts and permits. Okay, so if you've got new household formations, how do you satisfy new household formations? With new construction.
Yeah.
And so if we see housing starts at 1.6 million, but that's starts. That's, you put a shovel in the ground. You can't live in that, so you go with completions, 1.34 million. Now, we have to account for 100,000 homes just being destroyed annually, not being habitable, destroyed by fire. So really, completions that you can really live in, 1.24 million would be a good number. So if you've got new formations at 1.7 million and you have new home completions at 1.24 million, you've got more demand than supply, and that is a recipe for appreciation. Now again, we're in a period of hibernation right now. Everyone said, forget it. I'm not dealing with these high rates. But what happens if rates come back down, which I'm making the case for? Those buyers didn't just go away. They're just sitting on the sidelines. They come back. And that's why I know that the phrase, the Marry the House, Date the Rate is trite. We can also say, buy now, refi later, and you win. Because that is, I think in time we'll look back. The best time to buy a house was 2011. That was the best. The next best time, I think, is today, even with the higher rate. You hold your nose, you get in without the competition, and then we refinance you in 6 months. And now you've got the house, you're not dealing with the competition. It's probably going to appreciate from here. You get the lower rate then. And you come out on top. That's the case that I'm making.
So I'm a real estate agent. I sell houses in San Diego, and I can tell you that we are seeing houses stay on the market for longer. So what we saw for the last 2 years was high competition, multiple offers on every house across the board. We're not seeing it on every house. We're seeing it on some houses, mostly in high-end areas, also areas where let's just say more in the luxury end where there's more money being spent. Your average household is sitting on the market for 30 to 60 days. And that is normal, actually. It's a normal market. But we think it's bizarre because the last 2 years, a house is sold in 5 minutes. And now we're wondering, why is it taking so long? So the position that's putting buyers in right now is less competition. We are seeing prices, we're seeing homes sell for less than the asking price. Okay, so remember when sorry, I didn't mean to move your slide there. Remember when it was like you have to bid over and be ready to put 50 or 100 or multiple offers, and it was so stressful for people. Well, that's done, mostly, not entirely, but mostly. And you now have a choice. Like, you can't choose the house that you can get. It's like, well, found a couple houses that I like. All right, so that's good for buyers. And I agree with you. If you can just kind of hold your nose, as you say, go, okay, I don't like the rate, but let me go out there and buy the house I want without a whole bunch of competition, maybe get it under the asking price, probably get it under the asking price. That's a good situation. And maybe you're going to save more money in the purchase price, and then later on you refi it to a lower rate. So that's what savvy buyers are doing, quite honestly. And some people are still going to be scared and just watch the headlines. But one thing I want to tell everybody is that the media is not in the business of giving you solid, clear information. They are in the business of selling headlines and getting you to click, 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 watch. Oh, what's going on with this? And everything is scary sells. So that's what they're in the business. So it's a great time to buy. But we have to explain a lot of these things for people to really understand. Paul, we got about 6 or 7 minutes left.
Okay, we'll keep scrolling. Let me interject one point, and that is the point I want to make is don't pay points, right? Because you don't pay points now for a rate that you're only going to keep for 6 months. And there's also a 2-1, there's a buy down option out there that you hear a lot about. And again, because I think rates are going to drop, they are so expensive to buy the rate down. That rate, even the lower rate, is going to stink in 6 months. So why pay extra for it when it's going to be temporary? So don't pay points is my point.
Maybe use credit from the seller for your closing costs, so it keeps more money in your pocket.
Correct. Yep.
You can probably, your closing costs for some people will be a month or two of mortgage payments. So, okay, what's next?
All right.
Oops, that's the end.
So again, we can see that we've got new household formations that exceed the supply, and builder sentiment is down. They really got caught in the last recession, and they overbuilt. They built right through the recession, and so many went out of business. This time, they're just not building. So we're actually going to see supply diminish further. So what happens to housing during recessions? We just look at history, and it tells us what we might expect. And you go back to 1960. During every recession, we see modest appreciation, which is confounding to me. But again, if the unemployment rate goes up to 6%, 7%, 93% of the population is still working and can afford a house. And so it'll support home prices continuing to go up. Now, the only anomaly here is that 2008 Great Recession there, and housing dropped.
Yeah.
Well, the recession didn't cause the housing drop. The housing crash caused the recession. That's the only time we can see that housing went down. That's because it went down on its own, because back then, and I saw it, I never participated in it, but loan officers were relying on income for borrowers to get them into houses they never could afford. And they would simply refinance, because the house values are going up, to supplement the lifestyle they never could have afforded in the beginning. And when that crested, and went down, they couldn't tap into the home's equity anymore. Everything collapsed. The tide went out and the house of cards crumbled. That then caused the recession. Other than that, then we had another one, during the pandemic there in 2020, housing appreciated right through it. So we can expect the same during this next recession. I would make a case for nationally seeing low single-digit appreciation. In San Diego, I've been hearing we might give back 5% off the peak, which I think would be a win, but higher than it is today. So again, you buy now with less competition, you refinance later, and I think those who buy now will actually see appreciation in the next 6 to 18 months.
Yeah. And even though we're seeing more houses coming available, we still need more houses. So especially here in San Diego County, the way you need to look at it is we can't build north because of Camp Pendleton. We can't build west because of the ocean. So there isn't a lot of building. There isn't enough building going on, quite frankly, because people love to say, oh, San Diego's expensive to live in, and it's not cheap, that's for sure. Wages are higher here. Nationally, I think we're number 10. I just read an article, we're number 10 in wage increase as to how quickly the wages are coming up in San Diego. So there's a reason those people live here. And so we still don't have enough. We still don't have enough houses. So that's still a demand. And that's, that's going to continue. So thanks so much, Paul. It's been really interesting and educational, and I look forward to seeing what happens next year, and we can have you back. We can talk again next year and see kind of how things go. I'm hoping the rates go down. I want to buy more houses, and I want to be able to afford to invest some more in the next couple of years. So yeah, we're all looking forward to it.
So yeah, test me on this. So I'm saying mid-November 2022, we start to see rates decline. I'm at 6 3/8 with a point today. Let's see if that happens. I'm thinking by New Year's Eve, we're below 5%. And by the spring, we're below 4%. So there we go. Let's see what happens.
Okay, New Year's Eve below 5, spring below 4. Wow. All right. We'll see how it goes. Anyway, thanks for watching this video. This one was a little bit longer, but I wanted to make sure that we just, provide some value for you guys out there. If you're thinking about buying, please reach out to myself, reach out to Paul, and we'll get you started. The first step for home buying is to talk to a lender and get yourself pre-qualified, find out how much you can afford to buy. So we would encourage you to do that. And yeah, my contact info is all over the place. So, reach out and find me. Thanks again, Paul. We'll talk to you soon.